When it comes to investing, one of the biggest mistakes beginners make is buying stocks without doing any real research. They hear a tip from a friend, see a trending headline, or notice a company's stock going up and they rush to buy. But successful investors know that buying a stock without analysis is like buying a car without checking the engine. It might look shiny on the outside, but what matters is what's under the hood. So how do you analyze a company before buying its stock? What are the key steps to separate a good investment from a risky one? That's exactly what we're going to explore today. By the end, you will have a clear roadmap for analyzing any company like a pro investor. The first step is to understand what the company actually does. This might sound obvious, but you would be surprised how many people invest in businesses they do not even understand. Legendary investor Warren Buffett has always said, "Never invest in a business you don't understand." So before you buy, ask yourself, what does this company sell? Who are its customers? How does it make money? If you can't explain the company's business model in simple terms, you probably shouldn't be investing in it yet. The second step is to analyze the company's revenue and profit. Revenue is the total money the company brings in. Profit is what is left after expenses. If a company is growing revenue steadily year after year, that's a good sign. But revenue alone isn't enough. You want to see profits too. Some companies grow sales but still lose money because their costs are too high. Always check both revenue and profit trends over at least 5 years. Next comes margins. Profit margins show how efficiently a company turns sales into profit. If a business makes $1 million in revenue but only keeps $10,000 in profit, that's a 1% margin. Compare margins across competitors in the same industry. Higher margins usually mean stronger pricing power and a more efficient business model. Another key metric is earnings per share, or EPS. This tells you how much profit belongs to each share of stock. If EPS is growing consistently, it's usually a positive signal. But be careful. Sometimes EPS can grow artificially through stock buybacks rather than true business growth. Then we have valuation. This is where most beginners get confused. Valuation is all about figuring out whether the stock price is fair compared to what the company is worth. The most common tool here is the price-to-earnings ratio, or PE ratio. It compares the stock price to the company's earnings. A high price-to-earnings ratio means investors expect strong future growth. A low price-to-earnings ratio might mean the stock is undervalued or that the business is struggling. Always compare PE ratios with competitors in the same industry. Another useful ratio is price to sales, or PS. This is especially important for companies that aren't profitable yet, like many in the tech sector. It compares the stock price to the company's total revenue. If the ratio is sky high, it might mean the stock is overhyped. Now, let's talk about debt. A company with too much debt can be risky, especially during recessions or high interest rate environments. Look at the debt-to-equity ratio. This shows how much debt the company has compared to shareholders' equity. If debt levels are rising faster than profits, that's a red flag. Healthy companies manage their debt carefully and do not overextend themselves. Cash flow is another critical piece of analysis. Revenue and profit can be manipulated with accounting tricks, but cash flow tells you how much actual cash is moving in and out of the business. Free cash flow is the most important. It shows how much cash the company has left after covering expenses and investments. Strong free cash flow means the company has flexibility to pay dividends, buy back stock, or reinvest in growth. Speaking of dividends, if you are looking at dividend-paying stocks, always check the dividend payout ratio. This shows how much of the company's profits are being returned to shareholders. If the payout ratio is too high, the dividend might not be sustainable. If it is moderate with room for growth, that is a good sign. Now, let's step back from the numbers and talk about competitive advantage. Numbers are important, but they do not tell the whole story. What makes this company special? Does it have a strong brand like Apple? Does it have network effects like Facebook or Visa? Does it have patents, supply chain dominance, or massive scale that makes it hard for competitors to catch up? Warren Buffett calls this a moat. The bigger the moat, the safer your investment. It's also important to analyze the industry. Even a strong company can struggle if the entire industry is in decline. For example, being the best company in the DVD rental business didn't help Blockbuster. Look for industries that are growing, have long-term demand, and are adapting to new trends. Next, you want to evaluate management. Who runs the company? Are they experienced? Do they have a track record of success? Do they prioritize shareholders, or are they just enriching themselves with bonuses? Reading shareholder letters, listening to earnings calls, and studying leadership history can give you valuable insights. Don't forget about risks. Every company has them. Maybe it is supply chain dependence. Maybe it's regulatory pressure. Maybe it's new competitors. The goal isn't to avoid risk completely, that's impossible. The goal is to understand the risks and decide if the potential reward is worth it. At this point, you might be wondering, how do I put all of this together? Here's the simple framework. Step 1. Understand the business model. Step 2. Check revenue, profit, and margins. Step 3. Look at EPS and growth trends. Step 4. Analyze valuation ratios like price to earnings and price to sales. Step 5. Examine debt and cash flow. Step 6. Evaluate dividends if relevant. Step 7. Study competitive advantage and industry trends. Step 8. Research management and risks. When you combine all of this, you will have a clear picture of whether the company is worth buying. You're not just guessing, you're making an informed decision. But there's one more thing to remember. No matter how good a company looks, price matters. You could analyze a great company, but if you overpay for the stock, your returns may suffer. That's why patience is critical. Sometimes the best move is to wait for a better price. Remember, in investing, you do not get paid for activity. You get paid for being right. Let's use a real-world example. Take Apple. Understanding the business is easy. They sell iPhones, Macs, iPads, services, and more. Revenue and profit have been growing consistently for years. Margins are strong thanks to premium pricing. EPS has grown steadily, partly from buybacks. The PE ratio has been higher than average, but investors pay a premium because of Apple's brand and ecosystem moat. Debt exists, but cash flow is massive, making it manageable. Dividends are modest but growing. The industry consumer tech is strong. Management is respected. And the risks? Competition, supply chains, and innovation cycles. Overall, Apple has checked most boxes for long-term investors. Now, compare that to a struggling retailer with declining sales, shrinking profits, and heavy debt. Even if the stock looks cheap, it might be a trap. That's why proper analysis is so important. One final tip. Always compare companies to their peers. If you are analyzing a bank, compare it to other banks. If you are analyzing a tech firm, compare it to other tech firms. Industry context matters. And remember, analysis isn't about predicting the future with 100% certainty. It's about stacking the odds in your favor. It's about reducing risk by making informed choices. When you analyze a company properly, you're not gambling, you're investing. So the next time you are tempted to buy a stock because it is trending, stop and ask yourself these questions. Do I understand the business? Is revenue and profit growing? Are margins healthy? Is valuation fair? Is debt manageable? Is cash flow strong? Does the company have a moat? Is management trustworthy? And are the risks worth the reward? If you can answer yes to most of these, you might have found a great investment. If not, it is better to wait. Because in investing, patience and discipline beat hype and emotion every single time. And that's how you analyze a company before buying stock. It's not about being perfect, it's about being prepared. Do your homework, trust the process, and let time work for you.